Welcome to the latest Insider interview. Today I have Anna Macdonald, manager of the Amati UK Smaller Companies Fund. Anna, thank you very much for coming into the studio.
Thank you for having me.
What have been the most recent buys and sells in the portfolio?
We've been selling some of the more highly rated stocks that have done really well during the pandemic, where we have thought that there are some stocks offering maybe a little bit better value in the portfolio. We have found that that the market's pretty nervous at the moment, and we think that if if numbers aren't met, the stock's pretty savage. And in fact, even if numbers are met, if there isn't a confident tone and a likelihood of some upgrades, we've noticed that stocks really underperform. So we've tried to guard against that to some extent. There are companies that we've liked that we've sold. For example, Focusrite is a company. I think it's great. It does really good audio equipment and has made some really interesting acquisitions. It should grow out of the pandemic because in some areas of the business, because it does some live audio equipment, and we think there's going to be much more live shows. But the shares did look expensive, and so we thought that we would cut that. Another one similar to that was Genus, which is a stock that we really like, but yes, on quite a stretched valuation.
So that means selling shares that are expensive relative to profits. Mm-hmm. The fund invests in expensive shares generally. It's looking for growth. Is this going to change the way you invest now? Is it going to change the way you analyse companies, given that interest rates and inflation are affecting the value of future profits?
Yeah, well, I don't think it's going to fundamentally change the scope of our fund and the opportunities for our fund. What we're saying is that there are some companies that we think would have to deliver very strong growth to be able to justify their valuation, and we are doubtful in the next year or two whether that can actually come through. It doesn't mean that we're changing, whole scale what we're doing. We've actually got quite a balance in the portfolio. So there are some much better value stocks in the portfolio as well, which have got quite protective dividend yields that we feel are very well supported, like oil and gas stocks, for example, like our holding in i3 Energy.
And has that been the best performing sector for you this year, the oil and gas area of the fund?
Energy has been strong, yes.
You also invest a lot of the portfolio in AIM stocks, so smaller companies, perhaps more risky. What are your biggest positions there, and why do you like them so much?
We do have about 45% of the portfolio invested in AIM stocks. We know AIM stocks very well. We don't believe that they're inherently more risky than what you might find on the small cap main list. They tend to actually have pretty good growth opportunities, and some of the key names that we have there that are AIM listed are GB Group, Craneware, Accesso. These are all good technology companies that we've owned. There are some AIM stocks that, even though they are were of substantial market caps, we've steered clear of because we've been concerned over the business models and the potential for the companies. I suppose those stalwarts like Boohoo and ASOS we haven't owned. A successful stock that we held and bought into during their fundraising, the initial stages of the pandemic, was Jet2. We have sold our holding in that company, but that still actually offers quite good value. So there is a pretty good universe of very investable AIM stocks.
And you said growth might be at risk in some investment areas. So the macroeconomic backdrop is rising inflation, perhaps a recession around the corner. So what are the areas that you actually trimmed, which sectors, and why are you a bit worried about growth in those areas?
We think that households are going to come under pressure, so we have been trimming some of our consumer growth stocks, such as Focusrite, which I mentioned earlier. I think it's unavoidable that there's going to be a little bit of caution around those areas. Energy bills and other inflation is such that is unavoidable. However, we do know that those higher prices do benefit some players in the end, and whether that's a oil and gas company. So we know that there are some areas in the market that will still continue to do quite well, so we'll keep our exposure to them. But we don't want to throw the baby out with the bathwater. We're still looking for companies that have got small footholds in markets where we feel that they can grow, or where there are some kind of inexorable trends, like, for example, in digital transformation. Satya Nadella, the CEO of Microsoft, in his results a couple of weeks ago, said, when he was asked this question, have you seen any kind of caution or your clients talking to you about they want to delay spending? He said actually quite the reverse, because digital transformation reduces your the amount you have to spend on more expensive labour, and it increases your general efficiency and your ability to respond to markets and the ability to respond to consumers. So there are ways of playing that digital transformation which we don't think are going to get derailed. So that might be something like Bytes Technology Group, which has been quite a recent purchase of ours. So they have mostly software. They're a value-added reseller of software, mostly. Microsoft is a very significant client for them. And we think that company is set really fair to grow, even though it's in the tech sector, even though it might look quite expensive. We think it's going to be able to meet and raise expectations.
And did you buy into share price weakness at Bytes Technology?
Well, yes, we did end up. The shares have been quite weak, so yes, we did end up being able to get them far lower than they had been trading before. We like that sector. We used to own Softcat, and I like Computer Centre too, but those two are a bit too big for us.
And do you think, given where interest rates might be going and where they were for the past decade, we're now entering a period where investors don't want unprofitable but potentially fast-growing companies and are now going to look for dividends and secure business models? Are we entering a new period, or is this just a temporary blip? We're actually investing for growth like you do, is generally going to be the right investment strategy?
Certainly, if you look at where unprofitable companies were trading, their peak was February 2021. They have been sold off in the UK and in the US since then. So if we look at, for example, if we take Cathy Wood's ARC fund as our sort of exemplar of companies that are valued on multiples of sales and not valued on multiples of profit because they don't have any profit. So that has been a peak. So we've never really wanted to buy a huge number of those. We do have some unprofitable companies in our portfolio, but we've been we keep a very close eye on our exposure to unprofitable companies and to recent IPOs. So we'll have a limit that we won't go above in order to enable us to invest in companies that we do think are going to grow, but to be mindful of the investment environment around. We do see that the investment landscape is shifting in terms of what investors are able to tolerate, in terms of if you're just doing a simple discount model, if your interest rate's higher, the valuation at today's value is going to be lower. So we do need to think about that, how we we look at Quest in terms of looking at cash flow generation. We look at and the return on assets that we're seeing. I talk to analysts frequently, not so much about the perhaps exact earnings number that they're coming in with for next year on a company, but what their confidence is on a potential upgrade or downgrade. And we really think about that in terms of where these companies might be set. So we're not excluding companies that are known as growth companies at all, but we're trying to provide a balanced portfolio, really well diversified across lots of different sectors. And where we are paying up for that growth, we really want to have that confidence that the company is going to be able to deliver that growth in what might be a really tricky environment. So whether it's that underlying trend of digital transformation or an underlying trend of leisure park operators wanting to digitalise their offering to their customers. That's hopefully going to happen, whatever the environment is and whether it's recessionary or not.
And finally, the question we ask all our interviewees: do you invest personally in the fund?
Yes, I do. So I invest in the Smaller Companies Fund, in our VCT. I've invested in our new Strategic Metals Fund, and I'm about to invest in our new Strategic Innovation Fund. So yes, we definitely put our money where our mouth is.
Anna, thank you very much for coming in.
It was great to chat, thanks.
And that is all we have time for today. Don't forget to check out more insider interviews on the YouTube channel, where you can like, comment and subscribe.